Today is the 1st of March, 2026, and the tariffs have officially gone into effect. At the stroke of midnight, the latest round of U.S. tariff escalations became active. These measures now affect imports across several categories, including strategic metals, industrial inputs, and manufactured goods from specifically targeted countries. This isn't a warning anymore, it's not a bargaining chip either. This is fully enacted policy, now operational within the U.S. customs system, as of roughly 12 hours ago. And tonight, when commodity futures resume trading at 6 p.m. Eastern and Asian markets open for their Monday session, silver, gold, and the U.S. dollar will all begin reflecting the reality of what just took place. The consequences for precious metals are both immediate and structural in nature. The consequences for the dollar are clearly directional, and the consequences for silver in particular, given its reliance on cross-border metal supply chains, could be nothing short of explosive. Every figure referenced in this video comes from publicly accessible trade policy documents, exchange data, and macroeconomic indicators. Let me break down exactly what was triggered today, how it affects each asset class, and what deserves your attention when markets open in just a few hours. Let me begin with precisely what took effect, because the specifics are crucial, and most reporting is glossing over this as a generic headline. The tariff escalation that became active on March 1st falls under Section 122 Emergency Trade Authority. It includes sweeping import duties above 10% on categories that have both direct and indirect effects on the precious metal supply chain. The categories in scope cover refined metals, mineral concentrates, industrial components, and manufactured goods from countries falling under the reciprocal tariff framework. China, which accounts for roughly 70% of the world's refined silver production, is subject to the harshest tariff structure. Mexican imports, which include silver-bearing mineral concentrates from the planet's top silver-producing nation at 24% of global output, now face additional duties under the broadened framework. Here's the reason tariffs on these particular trade routes matter for silver in ways that extend well beyond simple price hikes. When you slap tariffs on refined silver and silver-bearing concentrates coming from China, you're essentially driving up the cost of importing the single most critical source of refined silver into the Western supply chain. Chinese smelters and refineries process silver ore sourced from their own mines, from imported concentrates and from recycled materials. That refined output then gets shipped worldwide to industrial buyers, ETF custodians, and commodity exchanges. Tariffs on Chinese refined silver don't cut Chinese production volumes. What they do is choke off the movement of Chinese silver into the United States and other Western markets. The metal simply remains within China. Chinese domestic buyers, who are already paying $18 per ounce on the Shanghai Gold Exchange, end up absorbing the supply that would have otherwise headed west. Western supply contracts. Western prices have no choice but to move higher. When you layer tariffs onto Mexican mineral concentrates, you're inflating the cost of the key feedstock that North American silver refining depends on. Mexico produces around 197 million ounces of silver each year, accounting for approximately 24% of worldwide output. A meaningful share of that production leaves the country as concentrate, destined for smelters and refineries in the US and Canada. Tariffs on those concentrates push up input costs for domestic refining operations, and that directly translates into elevated refined silver prices within the US market. But here's the more critical point. If those tariffs render it uneconomical to process Mexican concentrates domestically, refiners may scale back their throughput. That reduction cuts the physical supply of refined silver reaching the U.S. market, irrespective of price levels. The combined effect of tariffs on Chinese refined silver and Mexican concentrates creates a simultaneous squeeze on both the finished product supply and the raw material supply for the U.S. silver market. It's effectively a dual choke point, and it's kicking in on the very first day of the COMEX March delivery month. Meanwhile, registered silver already sits at 86.1 million ounces, the lowest level in modern exchange history. Now, let me connect the tariff activation to what unfolds for silver tonight. The COMEX reopens at 6 p.m. Eastern. By that point, the tariff regime will have been operational for roughly 18 hours. Market participants have had the entire weekend to study the tariff specifics, model out supply chain ramifications, and build their positioning for the Sunday night open. The trades that institutional desks coded over the weekend, based on their tariff impact modeling, will fire within the opening minutes of the session. Here's what the positioning data reveals about the likely direction. Silver closed Friday at $93.82 after surging 6.28% in a single day, fueled by short covering on enormous volume. Open interest has been on the decline, which confirms the rally was driven by shorts, capitulating rather than fresh longs entering the market. The concentrated short position held by 4 major commercial traders, estimated between 30,000 and 45,000 contracts, just absorbed projected losses somewhere between $900 million and $1.35 billion in Friday's session alone. Those shorts head into Sunday night's session in a weakened state, undercapitalized relative to the size of their positions, and now confronting an additional supply-side catalyst that directly reinforces the physical shortage thesis they've been pushing back against. The tariff activation hands long-side participants a fundamental reason to pile on. Industrial buyers who depend on Chinese or Mexican silver supply chains now face steeper procurement costs and the specter of supply interruptions. Their logical move is to lock in physical metal right away, whether through futures delivery or ETF accumulation, before the tariff-driven price surge fully plays out. That procurement-motivated buying hits the COMEX during Sunday night's thin liquidity window. If silver gaps above 95 dollars on the open, stop-loss clusters tied to short positions get triggered automatically. An estimated 3,000 to 8,000 contracts worth of buy-stop orders are believed to sit at or above the $95 level, and Sunday night volume typically runs at just 10% to 20% of a normal session. Those stops cascade through the $95 to $100 range, where there's virtually no sell-side liquidity. The tariff catalyst supplies the fundamental rationale. The positioning mechanics supply the amplification, and the delivery month timing supplies the structural backdrop. Now let me walk through the implications for gold, because gold and silver don't move in isolation, and how tariffs affect gold has a direct bearing on silver's trajectory. Gold ended Friday around $5,278 to $5,290. The gold market processes tariff escalation through two channels. First, tariffs are inherently inflationary. They drive up the cost of imported goods across the broader economy, which feeds into producer-level prices and eventually filters through to consumer prices. Rising inflation erodes the dollar's real purchasing power and makes inflation hedging assets like gold more appealing. January's PPI data already pointed to persistent producer-level inflation. The March tariff activation layers a fresh inflationary impulse on top of what was already baked in. Second, tariffs ratchet up geopolitical friction and trade uncertainty. When the world's largest economy slaps aggressive duties on its two biggest trading partners, China and Mexico, it destabilizes the entire global trade framework. Capital migrates towards safe haven assets as investors look to protect themselves against supply chain disruptions, retaliatory tariff measures, and the economic slowdown that reduced trade volumes can trigger. Gold stands as the primary safe haven beneficiary when trade uncertainty spikes. Wells Fargo's published 2026 gold target of $6,100 to $6,300 was set before the March 1st tariff activation even happened. Their thesis pointed to geopolitical risks, market volatility, and robust central bank demand. Every one of those drivers has grown more intense with today's tariff rollout. If the escalation speeds up central bank gold buying, which would be the rational move for any sovereign entity looking to trim its dollar-denominated reserve exposure amid aggressive U.S. trade policy, gold's trajectory toward $5,500 to $6,000 by mid-year gets steeper. And when gold climbs, silver follows with amplified momentum. The gold-to-silver ratio at 56.3 is already tightening, a sign of institutional capital rotating into silver for its higher sensitivity to precious metals moves. In every prior precious metals rally sparked by inflationary policy and geopolitical tension, silver outpaced gold by a factor of 2 to 3. If gold picks up 5% on the tariff catalyst, silver's historical leverage implies a 10% to 15% gain from $93.82. A move of that magnitude would land silver in the $103 to $108 range. That would bring the Western paper price into alignment with the Shanghai physical price for the first time since the January correction. Now, let me turn to the dollar, because the tariff's effect on the DXY is the third key variable shaping how silver, gold, and the broader commodity complex trade tonight. Traditional economic theory holds that tariffs should bolster the dollar by curbing imports, narrowing the trade deficit, and boosting demand for domestically produced goods priced in dollars. That theory held up when the U.S. was a manufacturing-driven economy with flexible domestic supply capacity. In 2026, the theory is falling apart because the U.S. economy simply cannot replace Chinese refined metals and Mexican mineral concentrates with domestic production on any realistic timeline. The tariffs inflate costs without generating domestic supply alternatives. The outcome is inflationary pressure without corresponding productivity gains, which amounts to stagflation. And stagflation is the most punishing environment possible for the dollar. The DXY closed Friday at 97.65, resting right on top of critical trend support at 97.40. Currency markets have been subdued heading into the tariff activation, with traders holding off on directional commitments until they had implementation confirmation. Tonight's open will reveal whether the dollar cracks below 97.40, which would validate a bearish technical reversal, or bounces off support, which would temporarily push back the precious metals catalyst. Here's why a dollar breakdown tonight is the more probable outcome. Central banks around the world have been stepping up de-dollarization efforts in response to assertive U.S. trade policy. When the United States weaponizes tariffs against its biggest trading partners, those partners have every rational incentive to reduce their reliance on dollar-based trade settlement and dollar-based reserves. China has been offloading U.S. Treasury holdings, stockpiling gold reserves, and pushing yuan-denominated commodity settlement. BRICS nations have been constructing alternative payment frameworks. Each tariff escalation strengthens the argument for moving away from dollar-denominated assets. If the DXY breaks beneath 97.40 tonight, the technical damage would point to the 96.00 to 96.50 zone as the next area of support. A softer dollar directly benefits precious metals because gold and silver are dollar-denominated. When the dollar weakens, the same ounce of silver requires more dollars to purchase, which drives the nominal price upward. Historically, a 1% drop in the DXY correlates with a 2% to 3% rise in silver prices. If the DXY slides from 97.65 to 96.50, that 1.2% to 2% decline would imply a 2.4% to 3.6% move in silver, adding roughly $2.25 to $3.38 to the price on currency dynamics alone. Now, let me overlay the tariff catalyst on top of the pre-existing structural conditions, because this tariff doesn't land in a vacuum. COMEX registered silver stands at 86.1 million ounces and is draining at a pace of 785,000 ounces per day. March delivery commitments sit at approximately 52.6 million ounces, representing 61% of all registered metal. The SHFE's zero-lot delivery restriction for non-hedging participants went live just yesterday. Shanghai physical premiums are running $14 or more above Western paper prices. This marks the sixth straight year of structural supply deficit, running at 67 million ounces annually. The cumulative shortfall since 2021 has reached 820 million ounces. Mine production remains capped at 820 million ounces due to byproduct constraints. ETF inflows have come roaring back, with single-day SLV inflows hitting 3.4 billion. The gold-to-silver ratio sits at 56.3 and continues compressing. The 10-year Treasury yield is at 3.95%, a 4-month low. The ratio is flashing the most aggressive institutional pivot into silver since this cycle started. Every single one of these factors was already bullish for silver before the tariff went live. The tariff introduces a fresh supply chain disruption catalyst into a market that was already critically undersupplied. It curtails the flow of refined silver from the world's dominant processing nation, China. It drives up costs on concentrates from the world's top mining country, Mexico. It creates inflationary forces that prop up gold. It threatens dollar stability through stagflationary dynamics. And it provides the fundamental story to justify the institutional accumulation that was already gaining momentum based on delivery month mechanics and vault depletion trends. The timing is remarkable. The tariff goes live on March 1st. The COMEX March delivery month kicks off on March 1st. The SHFE delivery restriction took effect on February 28th. All three events land within the same 48-hour window. Any one of them in isolation would be noteworthy. Their simultaneous convergence marks a structural turning point. Here's the bearish argument laid out plainly. Tariff announcements have a track record of being renegotiated, postponed, or walked back. The administration has repeatedly wielded tariff threats as bargaining leverage in trade talks, and has adjusted implementation specifics in response to market reactions on more than one occasion. If the tariffs get softened, delayed for certain categories, or carved out with exemptions for strategic metals, the supply disruption catalyst loses much of its force. Markets might price in the worst-case scenario Sunday night, then reverse course if diplomatic signals surface Monday or Tuesday. On top of that, the dollar could actually firm up on the tariff implementation rather than soften. If foreign capital pours into U.S. assets as a hedge against worldwide trade disruption, the DXY could bounce off 97.40 support and push toward 98.50 or beyond. Dollar strength would act as a drag on precious metals, partially neutralizing the supply-side bullish driver. The tug of war between supply disruption and dollar strength could generate volatility without a decisive directional outcome, producing a choppy session instead of a clean breakout. It's also important to recognize that the tariff's impact on physical silver supply flows takes weeks to months to fully show up in the market. Tariffs don't instantly yank silver out of the supply chain. Existing stockpiles, pre-tariff shipments still in transit, and already contracted deliveries create a buffer window where physical supply keeps moving despite the new duties. The initial market response may overshoot the actual near-term supply effect, setting up a sell-the-news window for tactical traders. But here's the gap. The bearish case can't close. Even if the tariffs get revised or partially rolled back, the message has already been delivered. Every Chinese refiner, every Mexican mining operation, and every global commodity trading firm now understands that U.S. trade policy encompasses aggressive levies on strategic metals. That awareness permanently reshapes supply chain strategy. Producers and traders will redirect flows toward markets that don't impose punitive tariffs, which means more metal heading to Asia and less heading to the West. This behavioral shift happens regardless of whether the specific tariff rate ends up at 10%, 15%, or 7.5%. And that behavioral shift compounds the physical dynamics that are already draining Western vaults. If Chinese refined silver that previously made its way to the United States gets rerouted to domestic use or non-US markets, the COMEX vault replenishment rate drops toward zero. Vaults that are already hemorrhaging 785,000 ounces daily cannot withstand a slowdown in inflows. The depletion rate doesn't even need to accelerate. The inflow rate simply needs to decline. And tariffs on Chinese refined silver are precisely the mechanism that causes that decline. The arithmetic at the vault level becomes straightforward subtraction with a diminished positive input and an unchanged negative output. Registered silver at 86.1 million ounces, minus 785,000 ounces per day in withdrawals, minus reduced inflows from tariff-disrupted supply routes, equals faster depletion. Faster depletion means the critical failure threshold, where registered silver falls below 20 million ounces and the delivery system ceases to function, arrives earlier than pre-tariff projections estimated. Here's what to monitor tonight in precise order. 6 p.m. Eastern. COMEX silver futures reopen. Track the opening print against Friday's $90.82 close. Any gap above $95 signals that the combined tariff, delivery month, and positioning cascade is in motion. 6 p.m. to 7 p.m. Monitor DXY futures opening at the same time. A breach below 97.40 validates the stagflationary dollar response to the tariff rollout and gives precious metals an added push. 7 p.m. to 8 p.m. Observe the gold futures reaction to the tariff activation. Gold leading silver, higher points to safe haven capital driving the complex. Silver outrunning gold points to industrial supply disruption as the main force. 9 p.m. to midnight Eastern. Watch the Shanghai open for Monday's session. The tariff implementation adds a new layer to the Shanghai premium equation. If Chinese refined silver now carries U.S. import tariffs, the metal stays in China, temporarily increasing Shanghai supply, but confirming the permanent rerouting of physical flows away from the West. Monday, 8:30 a.m. Look for any economic releases or trade policy statements from the administration. Any further tariff-related commentary will either amplify or temper the overnight move. The tariffs are live. The delivery month has started. The vaults sit at record lows. The Shanghai premium stands at $14. The dollar is perched on critical support. And silver is just $1.18 below the stop-loss cascade trigger at $95. 3 simultaneous catalysts, 1 Sunday night open. The market that opens at 6 p.m. tonight will not resemble the one that closed at $92.82 on Friday.